Hey everybody, JC Peretz here, founder of All Star Charts, and I am joined as always by my esteemed colleague, Mr. Sean McLaughlin. What's up, Shawnee?
Hey, I see you survived the FEMA national notification. How was it for you?
I guess it makes me feel good that that's like possible that they could do that sort of thing. Like that's pretty cool. If we get attacked by aliens or something, like they let us all know, like stay inside, like there's aliens. I don't know.
For those of you who have no idea what we're talking about, literally seconds before we just went live, our phones were just blowing up with these emergency notifications.
It works, I guess. It's probably not a bad thing.
Yay, hooray technology. Look at us.
All right. So anyway, meanwhile, we're trying to make some money in this market. We had a really interesting discussion today, I thought, about how we're approaching the market and the relative strength that we've seen in technology and communications really also really that mega growth really holding in there really well. Technology in particular, with a lot of other sectors making new lows, right? And the new high and the new lows list kind of sparking up a bit. You're just not seeing it in technology. And it's funny because you and I were completely on the same page, seems like, coming into this meeting, which is tending to happen more and more these days. I don't know if you've noticed, Sean, right?
That can't be good.
um, looking to maybe here's the thing. Let me set the stage. There's just so many areas in the market that are so messy. Some of them are resolving lower. So we were kind of focused on the ones that are not. And technology is certainly one of those. Notice how technology technically closed at a new all-time high on a monthly closing basis. The S&P did not, right? So the technology really showing that relative strength. You could really see that divergence stand out. And then it's not just on on a cap weighted basis. People are like, well, it's only a few stocks. Well, those few stocks are certainly doing well, but on an equally weighted basis, technology was doing great also. And this is equally weighted larger cap. You look at small cap technology, mid cap technology, also showing a ton of strength. Look at semiconductors as well, getting back to those former highs and failing, right? And you're looking at the FANG index here, so kind of broadening it out to more mega cap growth, also getting back to those former highs. You're seeing it all over the market. Just wanted to throw industrials out there as well, also failing at former highs, just to show you it's not just a technology story, but it's really the market overall. You're seeing it at the index level too, as you can see here, the S&P 500 and also the NASDAQ. So we're looking at the relative strength in technology, not making new lows with the recent weakness. Sean was looking at it too. You could be more conservative, you could be more aggressive. There's pick your poison. For me and Sean, we're taking a more conservative approach. We're going to let it dance a little bit. We're not necessarily calling it like, okay, today is the market bottom and we rip from here. We could, and I don't like selling those calls so much because I don't want to eliminate the upside. But a more conservative bet is what Sean is looking at here. And I'm going to agree with Sean here. Let him have it.
Yeah, so in our meeting this morning, actually, you, me, and Straza actually had three different viewpoints on this. I mean, you and I were closer in viewpoint, but we each had unique viewpoints on this trade. Straza wanted to be more aggressive. He was feeling bullish. He thinks the bottom is in that was set last week. He wants to sell like the 160 puts. He was even talking about buying calls, and I think I talked him off that ledge successfully, hopefully. Um, but he wants to be more aggressive. You and I we're thinking, this market is kind of stuck in this sideways slop here. The one thing that I like about this setup, JC, is that XLK is held up, as you mentioned, is held up better than other sectors. That gives me a little bit of comfort knowing that there's good premium at that 150 strike in November options, and 150, considering how well XLK is held up relative to its peers, 150 feels comfortably far away. On
Yeah.
the flip side,
Comfortable enough.
comfortable enough, right? And then when we were talking this morning, like, should we just sell the puts? And I said to you guys, I said, well, I think we're leaving money on the table if we don't sell the 175 calls, because I don't see an environment where XLK is going to rip back to new highs, at least anytime in the next 4 weeks. It could happen. And Straza fired off a case of why he thinks if the market settles here, XLK is going to rip higher. And he was pretty adamant about that. And I'm not saying he's wrong. I just don't see that happening in the next 4 weeks. That's the bet I'm making. So we could be more aggressive and do tighter selling tighter strikes here. Ultimately, what we did is we put on a strangle, right? We shorted the 175 calls and the 150 puts. We could have gone tighter, but I mentioned to you guys in the call this morning. I said, look, this doesn't feel like an environment where I want to be very aggressive in either direction. In fact, where most things are losing right now, anyone who's making aggressive directional bets in any direction right now is having a tough time. I would rather go for a higher percentage bet and go for the win than go for the maximally optimal trading gain in an environment like this. Am I making sense?
100%, know the environment we're in. This is a messy market across asset classes. Also, by the way, it's not just in tech, just tech's holding up the best. It's messy across the board. International indexes are a mess. Currencies are a mess. I mean, the only things trending these days are rates. And to be fair, that's the biggest reason why markets are so messy is because rates, people freak out, when people freak out when rates are moving. You know how like in places where it doesn't rain, like in San Diego, and it rains, like nobody knows how to drive, right? You know what I mean? Like, no, they don't know what to do. It's kind of like that when rates just are am I wrong?
No, you're absolutely right. And you brought that up this morning. Like, look, with rates ripping the way they're doing it's making market participants uncomfortable. It's something they're not used to, and there's going to be and there is spillover effects in other sectors, and that's what we're seeing playing out in the stock market right now.
No question. So let's just take a look at the options trade here. So these are the November short strangle, 250 net credit. We're selling the 150 puts and an equal amount of the 175 calls. XLK is trading somewhere right around in the middle right now, getting a total of 250 credit. If at any point we are able to buy that back for $1.25, we're going to go ahead and do that. Take the profit. Am I right, Johnny?
You're right, and you can kind of see it in this graphic here. We have a little bit more room to the downside to be wrong if the market sell-off starts taking no prisoners and takes everything with it. Meanwhile, that 175, like I mentioned, I feel like the current market environment would have to drastically change in the next 4 weeks for that 175 level to be tested. I'm not saying it can't happen. Of course it can happen, but we'd have to see a pretty significant change, I think, in market character for that to come into play.
No question. So if at any point from a risk management standpoint, prices of the XLK technology ETF close below $150 or close above $175, we're going to go ahead and unwind that position and take the loss, or maybe even a slight gain, but we unwind it nonetheless. Do I have that right?
Yeah, I mean, look, let's say, just argument's sake, let's say XLK sells off and it's trading at 149, 148. The most likely scenario or situation in that case is we're losing money in this trade. But depending on when that happens, on the calendar, if that happens on November 3rd, for example, when we're 2 weeks out from expiration, we still might be able to exit the trade for a profit. But either way, profit or loss, if we're below 150 or above 175, I want out, because that's telling me that this range that we're betting on is now expanding, and you don't want to be short a delta neutral credit spread in a expanding range situation. That's a recipe for disaster.
No, we want the opposite of that.
The exact opposite of that. Exactly.
All right, beautiful. All right, so this is the technology XLK technology ETF November short strangle. Collecting $2.50, selling the 175 calls and an equal amount of the 150 puts in November. Another angle at this is maybe just selling the puts. If you're more bullish on technology here short term, don't sell the calls, just sell the puts. Remains same strategy. You cover for half of what you collected, and if at any point it closes below 150, you unwind it. Right. So this one has 2 layers, but you could. And Straza, if you think that this is it, this was the low, then just sell the 160s.
Right.
Right. Which I don't like. I like being more conservative here, but isn't it?
Yeah,
I like thinking through what's the thought process behind these different strikes, right?
Right. You and I are on the same page as far as wanting to be conservative, but I don't hate it. If you agree with Straza and you think that the bottom is in and you want to be aggressive, I don't hate selling the November 160 puts. You can get about 335 for them right now. I think that's a good trade if you're bullish. I'm not bullish. I'm not willing to be too aggressively bullish or bearish in this tape, as I mentioned before. So I'm going with the more conservative trade. I'm going for the higher percentage chance of booking a win. That's high on my list right now.
And to remind everybody why we're choosing November as the expiration is because that is the sweet spot where that premium really decays. Can you just touch on that?
Yeah, well, it's not the optimal sweet spot. Premium really starts decaying once you get inside 21 days. But when I put on a credit spread like this, I generally like to go into what's called the not the front month, but the next month. So in options vernacular, and futures traders use this as well. Whenever anyone says the front month, we're talking about the regular monthly expiration series, and the front month is the whatever the next monthly expiration is. So right now, today is October 4th. October is the front month, right? October options expire on the 20th, I believe. So October is the front month. I like to sell 1 month beyond. That usually works out to be somewhere in the 40 to 55 day range. I like getting positioned there because I can get a nice credit usually. And then that positions me well as we get closer to expiration. Then the theta starts picking up rapidly. It really accelerates once you get inside 21 days. But anything longer, if I go further out, JC, if I were to sell December options or January options, certainly I could do that and get more premium for it. But the theta decay, which is what I'm betting on to make money, the theta decay just kind of moves at a snail's pace until you start getting into, underneath 60 days to expiration.
Well, all right. The November short strangle with technology. Guys, thank you very much. I appreciate everybody listening to our banter. I think it's very helpful for the audience to understand our thought process. And also, I really get a lot of value of thinking, out loud in public, kind of thinking through these different trades, why we're doing one and not the other. I really like that. So thank you, Shawnee.
Right on, my man. Well, good luck to you with this trade. Not that we need it. We create our own luck over here.
That's right. That's right.
But I like our odds.
All right, Shawnee. All right, guys. Thank you. Adios. See you next week.
Peace.